You ever see someone super smart make a financial decision that just makes no sense? It happens all the time. Well, today we're going to pull back the curtain and look at the hidden psychological traps that trip up even the smartest people out there. If you stick with me, you'll learn how to spot these traps and, honestly, get a real edge in your own financial decisions.
Yeah, I love this quote. If finance were only about math, every expert would be a billionaire. It just hits the nail on the head, right? Because if it really was just about numbers, every single person with a fancy calculator would be rolling in it. But they're not. The reality is, well, it's a lot messier than that. And that's what we're going to get into.
So what is that missing piece? What's the big X factor that separates what looks good on a spreadsheet from what actually happens with our money?
And the answer is, well, it's surprisingly simple. It's us, the human variable. I'm talking about our emotions, our deep-seated biases, all those little mental shortcuts we take. These are the invisible strings pulling the levers on our financial lives. Sometimes for the better, but as we're about to see, often for the worse. So today we're going to spotlight 4 of the biggest traps.
Okay, let's kick things off with trap number 1, and it's really personal one. Investor bias. This is where your own history, your own past experiences can really come back to bite you, right in the wallet.
So think about it like this. Investor bias is kind of like wearing a pair of glasses that only lets you see things that are familiar. It's comfortable, for sure, but it can make you totally blind to a whole world of new opportunities. It's that little voice inside your head whispering, hey, just stick with what you know, even when what you know isn't the best choice anymore.
Here's a perfect example. Picture a manager who only invests in local companies. Why? Because it feels safer, right? It's familiar. But that is a textbook case of investor bias. And by staying in that comfort zone, they could be missing out on massive growth happening somewhere else in the world.
All right, let's move on to trap number 2. This is one that has a funny way of sneaking up on you, usually right after you've had a bit of success. It's overconfidence. And this is the one where, believe it or not, your own success can turn into your biggest problem.
So what is overconfidence? It's when you start to believe your own hype. It's when you mistake a lucky streak or a rising market for your own personal genius. And look, we've all been there. You make a couple of good calls, things go your way, and all of a sudden you're thinking, hey, maybe I am the next Warren Buffett.
But here's the real danger. Overconfidence makes you reckless. You start taking bigger and bigger risks. You start ignoring the red flags, and you trade based on a gut feeling instead of actual data. And that is just a recipe for disaster when things eventually take a downturn.
Okay, trap number 3. This one is powerful because it feels like it's literally wired into our DNA. It's called loss aversion, and it boils down to a really weird psychological quirk. We hate losing way more than we enjoy winning.
Let me ask you a quick question. Just think about this for a second. What would feel stronger? The good feeling of finding $1,000 you didn't expect, or the awful feeling of losing $1,000? Which one hits harder? If you're like pretty much everyone else, the pain of losing that money stings a lot more. And get this, it's not just a feeling. Research actually shows that the psychological pain of a loss is about twice as powerful as the pleasure you get from an equal gain. We are hardwired to avoid losing at all costs. And in the business world, this fear of loss can be absolutely paralyzing. It's why so many leaders and companies just play it safe. They miss out on incredible opportunities for growth because they're terrified of the potential downside. It's like the silent killer of progress. All right, our 4th and final trap is a really sneaky one. It's called the disposition effect. And this is all about the totally irrational way we handle our winning investments versus our losing ones. Okay, so here's how it works, and it's wild. When an investment is doing well, we are so quick to sell it, right? We want to lock in that win, pat ourselves on the back, feel smart. But when an investment is losing money, we hold on to that thing for dear life, just hoping it'll turn around. And you know why? It's simple. Selling a loser feels like admitting you made a mistake, and our ego just can't stand that. Yeah, this breakdown just shows the flawed logic perfectly. When a stock is winning, we sell it to feel good. When it's losing, we hold on to avoid feeling bad. It's a terrible strategy. You're basically watering your weeds and cutting your flowers. And if you let your ego run your portfolio like that, over time, it's just going to be devastating.
Okay, so we've walked through the 4 big traps. Now for the million-dollar question, right? How do we actually avoid falling into them? How do we take this information and turn it into a real, actual advantage? It really all boils down to this one simple idea. Being successful with money isn't just about spreadsheets and data. It's about understanding human psychology. You have to understand it in the market, sure, but way more importantly, you have to understand it in yourself. It's about mastering your own mind.
So here's a super simple two-step plan you can start using today. First, just start paying attention to your own decision-making. Recognize your biases. The next time you're about to make a financial move, just pause for a second and ask yourself, wait a minute, am I falling into one of these traps? And second, build a system for yourself that forces you to be objective. Actually write down why you're making an investment, set clear rules for when you'll sell, and hey, maybe even find someone to keep you accountable.
All right, let's do a quick knowledge check. Let's say a manager sells a project that's making a ton of money just to lock in the win, but they keep pouring money into a failing project because they don't want to admit it was a bad idea. Which bias is that?
And the answer is the disposition effect. If you got that, you're spot on. That is a perfect textbook example of letting your ego and emotions dictate your strategy.
So I'll leave you with one last question to think about. Of these 4 traps we talked about, which one is your personal kryptonite? Seriously, take a moment to be honest with yourself, because just knowing that, just having that self-awareness, that's the first and most important step to making much, much smarter decisions.